Hello and welcome to our channel. My name's Charles Delastic. I'm the Managing Director of Bluebond Tax Planning. We've been helping clients save inheritance tax for more than 18 years as a specialist company. And today's video is all about how you can save thousands of pounds if you decide to utilise life insurance as a methodology for mitigating your tax. So today's video is around why you should have two life insurances rather than one, and why that will save you thousands. So cue the intro. Okay, as I explained, today's video is all around why you need two life insurance policies rather than one. So why two plans? So when a person does life insurance for inheritance tax purposes, the default mechanism is a joint life second death whole of life plan. So what exactly is that and what does that mean? Okay, so a joint life second death plan, it does work. It insures and pays the tax when the insured person dies. And you will find though that they're quite expensive over the terms of the policies. So we had a client who'd sold his business, and while he had the business, his accountant said to him, okay, you need to take out one of these plans. He was paying about £600 a month and he was only 52 years old. I said to him, well, you could live another 35 years, and if you're paying £600 a month for 35 years, well, it's almost like paying the tax, frankly. It's a huge cost to you over time, and there are much better mechanisms. And that's what we went in to explain. So, as I said today, we'll explain to you how you can save money by utilising two plans rather than one. So, firstly, what exactly is a joint life second death whole of life policy? Okay, so as it says, it pays out on the second death. So this isn't a term policy like you would take out for, say, protecting your mortgage, where it pays out when the first person dies, if you're a married couple. This pays out when the second person dies, because obviously inheritance tax is payable when the second person dies, right? Again, with these plans, why take out two types? Because there are two types of plan. So the first type is the standard plan, and you would utilise the standard plan to insure your retained assets. Now, what does that mean? So generally speaking, that's a person's main residence. They generally don't give that away because they're going to go and live in it, and if they did try and give it away, it would have some problems with inheritance tax because they're living in it. Then there's other assets. You would always want to keep an emergency fund, at least 50,000. So even if your income stream matched your expenditure or was higher than your expenditure, you would need to keep an emergency amount of money that you could get access to. So that's your emergency fund. There's all your chattels, your cars, your furniture. You may have some antiques. There may be some other assets you want to hang on to. So everything that you're going to retain. Now, it's really important that the calculation for this is done properly, because you've got to look at those assets and say, well, how much are they likely to grow over 20, 25, 30 years? And therefore, if you've got an insurance plan, well, you want a certain amount of cover now, and you want a much higher level of cover later on. So therefore, you've got to have an increasing plan, which the amount of cover increases over time, right? And therefore the premium will increase over time. So how do you do that calculation? And that's quite a difficult calculation to do. So you need a specialist piece of software or a specialist spreadsheet to calculate that out. But it's to cover your retained assets. Okay, so the other type of plan is called a maximum plan. So this is different to standard or balanced in that it's set up differently, which I will explain in a minute. So the main reason for this plan is to cover your temporary assets. So these are assets that you intend to give away. So you may have shares, you may have other property, you may have a lot of money in the bank, all sorts of assets. But if your income matches your expenditure, and you know you've got a big emergency fund and you can get your hands on some of your assets while still giving them away. We'll explain how that works in another video. But inevitably you want to give assets away, and you're either going to do that directly by giving them directly to your children, or you're going to give them into trust or whatever, or you're going to buy exempt assets, but you intend to take them out of your estate over time. Now that may take you anything from 5 years to 15 years to 20 years, and therefore you set up a maximum plan to cover you for that time period when you're going to be giving those assets away. So if you wish to, take a quick screenshot of this, because I'm now going to get into explaining how these two types of plan work for you. Okay, as I said, I'm going to explain how the two different types of plan work. So again, standard, sometimes known as balanced cover, and maximum cover. So what's the difference? Okay, so if we were to look at the premium, let's say look at it as a piece of cake, you'd have a small slice which was taken out on an ongoing basis for charges, and that's relevant to the different companies that provide the cover, etc., and whether commission was being taken out of the plan or not. Then you've got an element of life cover, and we'll explain how that works in just a second. And then you've got an element of investments. Now, let's say you're trying to insure yourself and your property is going to be worth, when you die in 20 years time, maybe a couple of million, and you need £500,000-600,000 worth of cover. So you need 500 Ks of cover. So what you do, as I said, your properties and other assets are starting there, but it's going to grow. So therefore you need an increase in cover over time, and your premium will also increase in time. Yeah, that makes sense. And the two equate to some degree. So as you've got this life cover, what happens with the investment? So over time, that investment will grow. So here's it growing with the stock market, and round about when somebody's, let's say, 80 to 85, depends on their health, depends on so many other things, the company would expect for that investment to meet the value of the cover. So then what happens if you die early? Okay, so if you die early, let's say you die at this point, what happens is that you get your investment back. So that's the value of what your investment might be. And you also get the top up with the amount of insurance. So therefore, whatever the value is at that particular time, hopefully covers your inheritance tax liability for those assets, and that's how it works. Now, it's expensive because of the investment element, right? Because you imagine if you're trying to save up £500,000 over 20 years, you're going to be putting in maybe well over £1,000, £2,000 a month. Depends on what the figure is, right? And therefore these policies are expensive. Therefore, that's why we set up this system of two plans, because this one is nowhere near as expensive. So explain how this works. So this is a maximum plan, and as you'll see, you've got life cover exactly the same way. You've got charges the same way, but the life cover now is the whole value of the plan. So the big cost, which is the investment cost, is taken out of that. So this, you've got the cover increasing over time. Sure, your premium will increase over time as well, but now you've got no investment element. So how that works is that instead of the premium going up like that, what happens is it goes up, and then every 10 years it takes a massive jump. So it could double or triple. And then in another 10 years, it could quadruple again. Right, so at which point that probably becomes, unsustainable, because you're paying £10,000 a month. I've no idea, right? But inevitably you've covered yourself, but it's that time period from here to here that you're giving yourself time to get rid of the assets from your estate in other methods. You're putting them into trust. You could put 650,000 in to a trust. You could downsize your property and give some of the excess capital away. There's all sorts of things you can do. And therefore, this maximum plan gives you time, but at a much lower cost. So let's just say we're talking about a 60-year-old. You may be paying up here £800 a month, whereas down here, you may only be paying £80 a month. It's not a small difference, it's a huge difference, right? And therefore that timescale and this methodology saves a considerable amount of money. The other thing you've got to watch out for is that the charges. If your advisor takes commission on a plan like this, the commission can be thousands of pounds, which I don't think is quite right. So we charge a fee, plus obviously the bigger the plan, the bigger the risk to our company because of our liability for the advice. So we charge a flat fee plus a very small additional cost, bearing in mind if it's a 2 million policy or if it's a £500,000 policy. And we explain that to clients. But generally, the saving, because you've paid an upfront fee, is huge. Over time, well, sometimes we've saved, I don't know, £10,000–15,000 for clients in terms of the difference in the premiums over the term of the policy. Okay, so in summary, setting up these two types of plans together makes sense. Some people will say, well, look, I'm giving the assets straight away and therefore I won't bother with this plan. But generally speaking, most people need that because you're going to retain some assets. But if you think your retained assets, of course, are not going to exceed your allowances of £1 million for a married couple, then you may not need that either. But it's a matter of looking at both of those and deciding which one's right for you, and that's part of what a good inheritance tax planner will do anyway. So that's why you need two plans, but generally speaking, the differences in the cost per month are huge, and this second plan and the value of that is it gives you time to then give your assets away in another format. Main thing about both of these is they must be written into trust, otherwise the values just fall back into your estate and then you get charged inheritance tax, which is the point is that the plans pay the inheritance tax for you, and it's the calculations of those two values and what they ought to be also require some specialist software, as I've said before. Hopefully you found that video of great use. If you did, please give us a like. If you are interested in inheritance tax overall and you've got a major problem, then you find links below to a free ebook guide that we do, and also a much more in-depth guide to inheritance tax, all of which are available from our website. But if you enjoyed this video just on its own, please give us a like. Thank you very much for listening, and goodbye for now.